With my dividend strategy, I focus on creating a passive income stream that will build me wealth that will eventually lead to financial freedom. Now, the big dogs like Warren Buffett and Bill Gates, they build their wealth in their holding company. So, Bill Gates has Cascade Investments and Warren Buffett has Berkshire Hathaway. But everyday regular investors like you and myself, we can build up our wealth in our regular investment accounts. So let's take a step back. Let's look at what a dividend paying stock actually is. When you take a step back, the bigger picture is that whenever you buy a dividend paying stock, you're buying an asset that has the potential to go up in value. But while you're holding on to it, it constantly pays you an income on a frequent basis, usually quarterly. The goal then is to keep buying these assets that keep paying you an income in the form of a dividend until you are able to live off that income, of those dividends. The last step is that you're going to be able, once you've built up this wealth, you're going to be able to pass it down to your family or next of kin, creating generational wealth. So in order to build all this wealth, which you are then able to pass down, you do need to look at analyzing companies that are trading on the stock market. Now, not all dividend paying companies are worth investing in. That's why one of the criteria that I've always had is that any dividend paying company that I look at needs to have been paying a increasing dividend for at least 10 years. Even better is looking at what this company paid as a dividend during a financial crisis, so a stock market crash. Usually when the stock market crashes, some of these companies, they might cut their dividend or they might even cancel their dividend. I don't like investing in those types of companies and those types of dividend paying companies. There are dividend paying companies that even during a financial crisis, they still pay an increasing dividend. Two of those companies that come to mind are Pepsi and Coca-Cola. Coca-Cola has paid an increasing dividend since 1963, around 1963, and Pepsi has paid theirs since 1973. So think about that large of a time frame and what has happened in the stock market, all the ups and downs, all the crashes. Even during the dot-com crash and during the housing market crash, Pepsi and Coke still were able to pay an increasing dividend. Now, Coke and Pepsi, of course, are not the only two high-quality dividend-paying companies. We will look at a long list of other high-quality dividend-paying companies that qualify for my criteria. But let's bring it back and let's look at actionable steps for your dividend strategy. What you want to do is find high-quality dividend-paying companies. Second, put them on your watch list. Third, buy them when they're selling at a discount. And fourth, manage your portfolio, your dividend income portfolio. So of course, whenever you buy them, they go in your portfolio, but you still need to manage them because not because a dividend paying company is a high quality today, does it mean that it will be one in the future. For example, this year I had to sell my shares in Disney because Disney decided to cancel their dividend. Because of the global pandemic situation that we're in, Disney had to close their parks, which ended up hurting their bottom line, and they had to decide to cancel the dividend. With the asset not paying a dividend anymore, the asset being the Disney stock, I'm not going to hold on to it. Now, where do you actually find these dividend paying companies to add to your watch list and to your portfolio? There's three ways that I do it. Either by looking at products that you use on a daily basis and seeing if those companies give a dividend to their shareholders. Number two is to look at stock screeners. And number three is the holy grail of dividend paying companies, a list of dividend paying companies, which is David Fish's Dividend Champions Excel spreadsheet. Unfortunately for us, David Fish passed away, but his system is still updated on a monthly basis. So a stock screener allows you to filter down to dividend paying companies. One that I like to use is on finviz.com. So just come to this website and click on screener in the menu, and you will have to apply some filters. So any company that pays a dividend is going to have a dividend yield. So let's apply a filter of over 2%, and let's look at some other filters to apply. Let's do country, the US. And while we're applying this filter, the total amount of dividend paying companies also adjusts. So like right now we're looking at over 2,400. Let's apply some additional filters to get that number down. Let's do return on equity over 5%. And let's look at the payout ratio over 10%. So we're looking at over 624 companies. I could go in and mess with the filters even more, but just wanted to quickly show you how this screener works. And just looking at this list, I already see one company that I have on my watch list, ADP. Let's see what else they got. So Bank First Corporation, I also have this one on my watch list, and I actually bought shares in this company also. So a stock screener is a good way to filter down to dividend paying companies, but if you want high quality dividend paying companies, one thing that I would look into is the David Fish, his Dividend Champions Excel file. So in order to get to David Fish's list, his dividend list, all you want to do is go to your favorite search engine and type in David Fish dividend. And the first result, just click on it. And you want to look for the Dividend Champions Excel spreadsheet. So open this one up. And while this is opening up, this list will contain dividends that have, or dividend paying companies that have paid dividends for, at least if you look at the Champions tab, these are dividend paying companies that have paid a dividend, a growing dividend, for at least 25 years and up. If you look at the Contenders tab, you'll see companies that have paid a increasing dividend for at least 11 years and up. And then the Challengers is up to 10 years. I like to look at the next tab, which contains all the companies. So let's see how many companies are on this list. There are 758 companies. So that's way too many to have on a watch list and to keep up with. So you do want to filter that list down, which is what we'll do right now. Let's apply the filter and then scroll to the left. One thing that I do is I don't like to invest in oil companies, so let's take those out. And then I only like to look at companies that have paid a dividend for at least 10 years. So anything below that, let's filter that out. And then with the dividend growth rate, I don't like to invest in companies that are not able to grow their dividend faster than inflation, which is around 3 to 4% each year. So let's filter out anything that's less than 4%. So let's just do greater than 4. Let's double check to make sure it worked. 4%, yes. And now, so we went from a list of over 700 to a list of 337. So it's a lot more manageable to go through this list. It's still a lot of companies, but let me increase the screen size and let's look at some of these companies. So for example, when I'm looking at this list, Realty Income, that's one of the companies that I own stock in, which is a monthly paying real estate investment trust, a REIT. What else? Kimberly Clark, that's also one that I bought shares in. Digital Realty Trust, I have them on my watch list. So definitely use the David Fish's Excel spreadsheet to locate companies that you normally wouldn't know about. It's one thing to look at companies that pay a dividend, companies that you use on a daily basis that have products that pay a dividend, but you're always going to be limited to your surroundings. So that's why you want to use a screener, or you want to use David Fish's Excel spreadsheet to locate companies that you normally wouldn't know about. So lastly, let me show you my watch list of dividend paying companies, and some of these I already bought stock in. And I think I have over 60 on my watch list. And you can always pause the video and just look at the ones that I have on my watch list. $67 on the watch list. We looked at how you can find dividend paying companies by looking at a stock screener or using a stock screener, and also using David Fish's Excel spreadsheet. Of course, there's other techniques that you can use, like the dogs of the Dow, looking at the dividend champions list, or even the dividend aristocrats list. The next step is to buy these dividend paying companies when they're trading at a discount. You never want to pay for an overpriced stock. Now, how can you decide if a stock is actually overpriced or trading at a discount? Let me give you an example, and then I'll tie it in to a financial or a stock market metric that we use to decide if a stock is overpriced or not. There's a group of entrepreneurial teens, and they've set up their own lemonade business. Their lemonade business is so profitable that they are generating $100,000 in profit each year. So if you take their sales and you take out their expenses, what ends up is their net income or their earnings, which is their profit of $100,000. Now, they've been able to generate $100,000 per year for a couple of years, and they got tired of this business and they want to move on to something else. They are really entrepreneurial, so they want to try their hands in different businesses. They decide to sell this business to you. If money was not an issue, how much would you pay for this business? So keep in mind, this business constantly generates $100K in profit every year. If money was not an issue, how much would you pay for this business? So one way, and also my favorite way to decide how much you should pay for this business, is to think about how fast you can get your invested money back. So if this business makes $100K, let's say you were able to negotiate and buy this business for $100K, you would get your initial investment back within a year, and everything after year one would be a pure profit. Now, if you paid $200,000 for this business, it would take 2 years for you to get your initial investment back, and then everything after year 2 is total profit. The benefit of this is that once you get your initial investment back, you own the business and you can take your initial investment and invest it in a different company. So let's say these entrepreneurs come up to me and they want to sell their lemonade business for $100 million. Keep in mind it only generates $100,000, but they want $100 million for their business. I'm not gonna buy it because it's gonna take me 1,000 years to get my investment back. People don't even live that long. So there needs to be a balance. After some negotiations with the entrepreneurs, they decide to sell their business to me for $1 million. That means that I will get my investment back in 10 years. So to say it another way, I paid 10 times the profit, the earnings, or the net income of the company. The company is generating $100K and I paid that times 10, 1 million. On the stock market, there's a specific metric that we use, which is called the PE ratio, the price to earnings ratio, or price divided by earnings. If you think about the company, the lemonade company that I bought, the price was 1 million and the earnings was 100K. But if you look at a stock such as Coca-Cola, their price is $51 and their earnings, which is net income per share, was $2.12. Take the price, which is $51 divided by 2.12 is 24. So you're willing to pay 24 times the earnings of the company. Now, when it comes to buying these dividend paying companies at a discount, I'm looking for a PE ratio of 20 or less, and 15 or less is even better. The last step is to grow your dividend income portfolio by constantly buying these high quality dividend paying companies that you have on your watch list at a discount and then you only sell companies that either cut their dividends or cancel their dividends.